So the Bank of Canada has just announced another 0.5% off the prime rate, which obviously everyone keeps asking me what that difference that makes to their mortgage.
We're here with our mortgage professional, Rylan. So, Rylan, what does that mean?
Well, for some people it means quite a bit. Other people it means not much at all. So clients who already have mortgages, if you have a fixed rate, doesn't really mean a whole lot because you're fixed for that set term. If you have a variable rate mortgage, it means that you're saving another 0.5% on your mortgage. So either your payment's going to be decreasing if you have an adjustable rate mortgage, or your cost of borrowing is going to be decreasing and you'll be paying off more principal if you have a traditional variable rate mortgage.
So anyone who's coming up for renewal next year, this is good for them because it means that it won't be obviously 2020 pricing like they originally had, but if they're up for their 5-year renewal next year, then it certainly eases the burden compared to where we were even a year ago.
Yeah, I think it gives more choice in pricing. For the last probably 18 months, the choice has really been, for the most part, 3-year fixed, 4-year fixed, 5-year fixed rates, just because the variables were 1-2% higher, so it was really tough to make a business case for it.
Mm-hmm.
Whereas now, with the most recent prime rate change, you really have parity in pricing. In a traditional market, we'd often see the variable rates being about 1% below the fixed rates, and for the last couple of years, it's been about 1% above. So it's been pretty tough to pick the variable. But now we're at about parity now, so the rates are fairly similar, and projections are for us to potentially return back to that quote unquote norm of the prime rate being about 1% below the fixed rates.
And typically, because a lot of people turn around and say, oh, fixed rates have now reduced because the prime rate's gone down.
Yeah.
But my understanding is that fixed rates are actually attached to the bond market rather than the prime rate. Is that correct?
Yes. So it's interesting right now. So when rates first started to decrease about 6-7 months ago, the bond rates and the prime rate moved together. So I think the bond rates is sort of like the world market's perception of the Canadian economy, whereas the prime rate can be directly controlled by the Bank of Canada and can move up to 8 times per year. And so originally when the Bank of Canada was decreasing the prime rate, we were seeing fixed rates kind of move in unison with them. So we'd see the prime rate go down, the fixed rate go down, prime rate go down, fixed rate go down. But then in the second to last prime rate change back in October, we saw them almost decouple from each other, where we saw the prime rate come down and the fixed rates pretty much stayed the same. And the last time, about a week ago when the rates went down again, we saw the rates go down, fixed rates stayed about the same. And so we're starting to see that. It's almost like the lines are crossing, whereas the prime rate was here and the fixed rates were here and they were kind of moving down like this. Now we're seeing them go at parity, and there's a good chance we'll start seeing the prime and variable rates down below soon.
Okay, good to know.
So, what kind of difference does that make if the prime rate is like far, far below? Like, if the fixed doesn't move, like, what kind of difference does that make for somebody wanting like a variable or a fixed mortgage?
Yeah, so kind of two differences. So right now we're at parity, so there isn't a big difference right now. But what could happen is if the prime rate continues down and the fixed rates stay fairly static, is we could see the number one, your payments are less by choosing the variable, but then number two, your qualifying can become a little bit easier as well. And so what we see based on the current Government of Canada guidelines is there's something called the stress test, and so we're qualifying a mortgage at a rate either at the base rate, which is 5.25%, or 2% above your current rate. And so right now, if we're doing a mortgage at, let's say, 4.5%, behind the scenes we're qualifying for a rate at 6.5%. But if we see the prime rate down to, let's say, 3.5%, well, now they're qualifying at 5.5% for a variable or 6.5% for a fixed rate, if that trend continues down. So it could essentially be much easier to qualify for the variable than for the fixed rate, which could then expand what clients are able to purchase.
Okay, cool. But there's been lots of other changes as well. I mean, we're in December now, which is when obviously we had all the changes to insured mortgages, which I know some people were like really thankful for. The fact that because it's been at that million mark for so long, and obviously they've now announced that obviously come December, then that was changing 15th of December, wasn't it?
Yep.
And so we're now in that part where
Yeah,
you can go a little bit.
December
more
15th
crazy,
was a red letter day in the mortgage industry, and so there were three changes that came into effect on December 15th. So first one, and the one that you just mentioned, up until that date, if you bought a home, basically, if you wanted to do less than 20% down payment, you had to buy a home $1 under $1 million. And that million now moved to $1.5 million. And so, for example, a client decided to buy a place for $1.5 million now. Previously, it would have been 20% down, so it would have been $300,000. And now, now the change has made it so that basically it's $125,000.
Yeah.
So a pretty substantial change in that qualifying amount.
Because it's still the 5% on the first 500 and then 10% on anything above?
Correct.
Okay.
Yeah, so for $1 million above 500, that's $100,000 a down payment for that
Yeah.
piece, and 50,000 for, or sorry, 25 for the initial piece for a total of 125.
Okay.
You know, we do need strong income to qualify for that.
Yes.
But where I think in the Calgary market and surrounding area market that we really see that expansion is, we've seen a lot of that, a lot of the market move into that, you know, $1 million adjacent.
Mm-hmm.
And so now it just gives a lot more options. If you find that perfect home, you know, at $1,050,000 versus like, you know, $995, you can still act on that without having a substantially bigger down payment, or 1.1 million. So I think it really broadens that $1 million adjacent market in Calgary, which is awesome for people.
So do you think that's a result of just kind of house prices going up naturally, kind of what would have been considered like a $800,000, $900,000 home is like now moving above the $1 million mark, and it's not an insurable mortgages for people looking for those kind of homes. So do you think that this change is a result of increase in house prices?
Yeah, like the industry, so bear in mind this is nationwide lending and nationwide policy. And so the Toronto and Vancouver markets have been asking for this for a very long time. They've been asking for this for a long time, or they've even been asking for like a split policy where certain markets in Canada have different tiers.
Mm-hmm.
And this was sort of the choice that the government ended up making, is just everybody goes to $1.5 million. So yeah, they've been asking for it for a long time. I think it really does benefit Calgary because we have so many million plus or minus homes that fit a lot of people in a really good way.
Yeah.
Yes, so there was some difference this year in the changes to amortization periods. In my understanding, it's for first-time home buyers or people purchasing new builds.
Yeah.
So could you tell us a little bit about that?
Yeah, so the minimum amortization, so we've had two changes December 15th, and then one change actually happened back in August. So the three changes, and they all coincide together now, are, I guess the end result is anybody buying a new home build now can do a 30-year amortization. And so what does a 30-year amortization do for clients? It expands what they're able to qualify for by about 8%.
Okay.
And so, you know, if you ran your numbers at a 25-year amortization, and let's say, for example, you know, let's say your numbers stopped at $500,000, and you said, hey, I'm kind of stuck here, but I'm looking at this, you know, this new townhouse or street town that's 530. You know, now that you can go to a 30-year amortization, that number moves from about 5 to about 540.
Right.
So you're able to fit. It's not a dramatic change, but it's a change that can fit some price points really, really well for clients.
Yeah.
Again, with a 30-year amortization, right? So like if we sort of look at the history, and I've been doing this for a bit more than 20 years, right? There were times there, when I first started, it was 25, and then it went to 30, then it went to 35, then we had 40-year amortizations for a while. Heck, we had 0 down 40-year amortization mortgages during some interesting times. And then we contracted. So then we took that 40 down to 35. Then that 35 went down to 30, then went down to 25. And so now we're sort of expanding back out to 30, which just gives clients a bit more breathing room.
It does. I know that I've got some clients who find, you know, over the 30 years rather than 25, it just eases their burden slightly.
Yeah, especially on the way in, right? The thing to bear in mind is that clients' careers will progress, hopefully their income increases, and that amortization can be shrunk as well. So just because we start with a 30 doesn't mean we're ending at a 30. Your mortgage will have really good prepayment privileges of usually 15 or 20% per year to help speed that payment up.
Yeah.
So we can effectively move that 30 down to almost any number a client would want, as long as they have the comfort level and the resources to do it.
And it makes such a difference overpaying your mortgage just by that little bit every single month to bring down that amortization period pretty quickly, because you're paying down the principal rather than the interest.
Yeah.
And therefore, you know, you can see that happening, you know, so if someone has a little bit of wiggle room, Even if variable ends up being below fixed and they start paying it as if it's a fixed, just to allow for that little bit of adjustment, that's kind of a good idea because then they're overpaying and directly paying down their principal rather than paying down the interest, and therefore it cuts down their interest over time.
Yeah.
And it makes if you play with different scenarios, and I do this sometimes with a mortgage, I play with different scenarios and go, oh, if I do this is what's going to happen. So that's always a good thing to kind of think about as well, because you give your clients the scenarios of, okay, if you do this is what it will be, and if you do this is what it will be. And it's always a good idea to ask someone who's knows about this and is really professional and can actually give you all the different scenarios, because you need to know what your options are, and there's a lot of options out there. First time buyers, for instance,
A little more confidence in the market kind of gives you a little more wiggle room. Not an incredible difference, but I think that it's a nice change for first time home buyers for sure.
Yeah.
there's also some first time buyer programs out there, isn't there? There's that one program that's out there from the government.
Let's finish off the 30-year AM, because
Okay,
I didn't quite finish that. So
Sorry.
30-year AM. So first one was anybody buying a new build can go 30, and any first time home buyer buying any home can go 30.
Okay.
So first time home buyer just means either A, you haven't bought a home before, B, you're coming out of a relationship breakdown, whether it be
that's
divorce
interesting that was in there.
or
Okay.
common law. It's a pretty relatively broad conversation. But yeah, any kind of serious relationship breakdown, you can be considered a first time home buyer again.
Yep.
And then the third is if you haven't owned a home for the last 4 or 5 years, there's kind of a cutoff in between 4 and 5 years, then you could be considered a first time home buyer again. So if you owned a place back in 2015 and sold it and moved abroad or were renting and now decide to buy again, you can be considered a first time home buyer again.
Okay, that's good to know, because most of us would just take first time home buyer as literally this is your first home.
Yeah.
But if you're coming out, of a divorce, then
Yeah.
that's pretty significant as well for
So
people who've had that dramatic change to their life anyway, that they can qualify hopefully for the program too.
yeah, absolutely. And really, the divorce one is a bit of almost like a Bob Ross, like a happy accident. That's not being divorced, but but being included in the program as a first time home buyer.
Yes.
The reason why the divorce scenario was originally included as first time home buyers is, as a first time home buyer, you're able to withdraw money from your RSPs for down payment. There's also the first time home buyer savings account, but from RSPs. So where we see clients coming out of a divorce, for example, and let's say they've settled their assets and it's all locked into RSPs, and they're going, well, we'd like to buy a home, but we might have a lot of assets, but not ready cash. They're able to then access those RSP funds in order to use that for their down payment on their new place.
Mm-hmm.
And so that's why they're considered a first time home buyer, or that's the intent behind the program. But then the knock on effect is, because they're a first time home buyer considered, they can also qualify then for the 30-year amortization.
Okay.
So it's sort of a happy accident that they got included in the 30-year AM program, because they can access their RSPs.
It makes things a little bit easier in a traumatic time, I guess. So
Absolutely.
that's ideal. So
Yeah, it gives a bit of breathing room until you know kind of what your budget, your numbers are, and you've stabilized out life a little bit.
yeah. So at the moment with the mortgage rates, because everyone's kind of going, okay, so if we were going to go out today and buy a $500,000 home, kind of what are our repayments
What would
roughly
repayments
looking
look
like?
like?
And I know it varies because obviously depending on.
Well, if you ever want to use kind of a back of the napkin math, think of every $100,000 a mortgage as being a touch under $600 a month in payments.
Okay.
A little bit under that. So if you're buying for, if you're doing a $500,000 mortgage, for example, your payments are going to be in the upper 2000s.
Mm-hmm.
So if we did the 600 times 5, it'd be 3,000. So essentially a touch under that. So we'd be in the upper 2s.
Yeah.
And on a bit of a more condensed level, think of every $10,000 as being about $50 to $60 a month in payments.
Mm-hmm.
Change. And so sometimes clients will say, Rylan, should I do $40,000 or $50,000 then? And and I think the answer is every client's a little bit different, and so there isn't really a right or wrong. Some clients, that extra $10,000, they're moving in, they're buying furniture, they have moving costs, they have life costs. That $10,000 is much better suited for them in cash. Other clients, they just prefer to make it the down payment. And what's the tangible difference? About between $50 and $60 a month in payments.
Okay.
I'm Fraser Perry from the Julie Perry Real Estate Team.
I'm Julie Perry from the Julie Parry Real Estate team.
I'm Rylan Hahn from Roost Mortgage.
We just wanted to bring you guys some clarity on mortgage information. We work out of Remax First in Calgary, and Ryland also works within the office. He's a fantastic mortgage broker that we recommend for any information or to use for buying your dream home. Thank you.